Back. Moving on. Allow me to introduce one of today's co-chairs and the moderator for this panel, our dear Richard Venn, to introduce the Real Asset panel. Richard is a senior executive vice president at CIBC, as well as the deputy chair and managing director of CIBC World Markets. During his 35-year career with CIBC, he has led most areas of investment and merchant banking, culminating in his role as chairman and chief executive officer of CIBC's Canadian dealer. Without any further ado, it is my great pleasure and privilege to welcome Richard Venn.
Straighten these out. Okay. Thanks very much for joining us this afternoon. I'm sure we'll have people begin to move in as we get them out of the elevator. Thank goodness we didn't have anything to move everybody out quickly out of those elevators. That challenge. Let me introduce the panel we have here to talk about real assets. And as I look out in the audience, we have a fair degree of expertise in this area in the audience, so I'm sure we'll get some skill testing questions from the group here. On my immediate right, and moving from left to right here, or your right to left, Matt O'Brien, who's the managing partner of Connor, Clark and Lund Financial Group. Matt is the president and managing partner of Connor, Clark and Lund Infrastructure. Connor Clark Infrastructure invests in small and mid-sized projects within the infrastructure sector and is part of the Connor Clark Lund Financial Group. In addition to his expertise in infrastructure, Matt has had extensive experience in corporate finance, having been a managing director in the M&A group of RBC Capital Markets. On his right is Tom Schwartz. And Tom is the president and chief executive officer of CapREIT. CapREIT owns interest in multi-unit residential properties in or near the Canadian urban centers. Mr. Schwartz has been involved in the development of real estate across all market segments over 30 years and has participated in development, construction, and management of over 600,000 square feet of office, commercial, and retail space. And on his right is Jack Pasht, who is the managing partner of the Terra Park Group. Jack is the co-founder and co-managing partner of the Terra Park Group, founded in 1989. The Terra Park Group focuses on investing in parking properties in cities throughout North America. Jack has written prolifically about the North American real estate market and analyzed over 1,000 parking properties throughout the continent. So if you need a parking space, call them. So with that kind of introduction, let me go across the group and ask each individual this question. Where do you see the greatest opportunities in real estate asset investing today? And maybe we can start with you, Matt.
Sure. I'll maybe start by saying a couple words about infrastructure, because I think it's a relatively new asset class, and maybe some of you are probably a little less familiar with it than others. But we think of infrastructure as encompassing two broad categories of asset. One being traditional infrastructure assets, roads, bridges, schools, hospitals. The other being energy infrastructure assets, which would be power generation assets, transmission assets, energy conservation assets, and so on. And while all these assets are pretty distinct physically, they can be reduced in all cases to a pretty simple concept, which is that each is really a single contract between us, the private sector investor, and a government or government-related entity. And it's from this basic contractual foundation that they derive their investment characteristics, namely that they generate a relatively stable, long-duration cash flow stream. And it's as a result of that yield-oriented set of characteristics that these assets tend to be valued in inverse proportion to sovereign yields. And so when sovereign yields are, as they are currently, at historic lows, infrastructure valuations, and in particular valuations on operating infrastructure assets are tending to be at historic highs. And so, to the specific question, which is where are there opportunities in this particular space right now, I'd start by saying that the opportunities tend not to be in the operating infrastructure segment. Valuations in the operating asset segment are extremely high right now, and when you couple the fact that yields are low and valuations are high with the fact that there's a massive amount of pension plan capital that's been allocated to this asset class and is competing for de-risked operating infrastructure assets, those two things lead to a degree of frothiness. And so our focus is not on the operating infrastructure segment, but rather at the late development and construction stages of these assets. And in that phase of development, the construction phase, there tends to be some what I'd call structural constraints on competition for assets, namely that infrastructure assets of any consequence, of any scale, are built at least when private sector funds like ours invest in them with fixed price, date certain construction contracts. And there are only, I'll say, a handful of construction firms in the country that have the size, capability, and credit capacity to backstop those kinds of contracts. And as a result, there's an inherent limitation on the number of parties that can bid on those kinds of contracts. You need to have some kind of an affiliation with one of those builders, and that creates a structural constraint on competition. And a byproduct of that is that the gap between the rates of return one can earn on a construction stage investment in infrastructure and what one can earn on an operating stage investment in an infrastructure asset has widened here over the last 3 or 4 years as sovereign yields have declined. And so that's where we see opportunity in the infrastructure space is in that more constrained phase of development rather than in the operating phase, where in the operating phase, the only way to distinguish yourself in terms of bidding on operating infrastructure assets is in respect to your cost of capital. In other words, you got to pay the highest price. At the construction stage, as I mentioned, there are constraints on competition, but there are also a whole range of factors that drive the relative competitiveness of different bids for an asset. And one of those factors is the cost of equity, but it's probably the least important of the factors. The other factors are, construction cost in terms, cost of debt financing, cost of operating the asset once it's built, which we largely try to fix at the outset. And all of those factors together dwarf considerations related to the cost of equity. So it's that's another argument on, in favor of focusing on that segment of the market where you can distinguish yourself in ways other than by simply having the lowest cost of equity.
Tom?
Yeah, thanks. At CAPREIT, we break our opportunities between internal and external. External has been our greatest opportunities. We've grown our REIT. We were Canada's first department of REIT in May of 1997. We went public with 2,900 units. A lot of skepticism in the capital markets whether we could build an apartment company in Canada. Today, 15 years later, we're over 37,000 units. All that growth has been through acquisition. We expect that to continue. This year alone, we've bought over 6,000 apartments. And again, external opportunities in Canada are abundant, and we certainly get our fair share. It's driven very, very much by the most stable stream of income in real estate. We operate at an occupancy of 98.4% on average across Canada. That's about as full as you can get. And we have two prime drivers to our business that are unique to apartments in Canada. Because of CMHC insured financing today, we're getting 10-year mortgages at 2.8%. That's incredibly accretive. That drives a lot of deals, and again, we're the only asset class that can take advantage of that. And the other very important factor is we're buying assets at less than 50% of replacement cost in all of the major cities in Canada. As we know, there's been virtually no new apartment construction in the past 20 years in our major cities, so we have finite supply, we have growing demand, and again, that drives our 98.4% occupancy and our external growth. Internally, because we're a large company, we can take advantage of economies of scale. We're seeing great internal growth opportunities. Our two most profitable departments at CAPREIT today are energy management and central purchasing. Energy management is major. We do energy efficient boilers in virtually all of our buildings. We're on third generation water saving devices in our buildings, energy efficient light bulbs, insulation, windows, virtually anything we can do. And frankly, a lot of those energy investments are more accretive than buying buildings. We buy a building today at a 5 cap. We buy an energy efficient boiler. It works out to be a 15 to 16% internal rate of return. We've found boilers that have an 8-year payback and a 35-year life with minimal maintenance. So again, energy management is extremely profitable, and that will continue. We never seem to run out of opportunities. The central purchasing has also been a big internal driver of profitability. We do our tenders nationally across the country. We're finding companies that can supply us nationally. It's extremely competitive, and again, it's driving a lot of money to the bottom line. Everything from pest control to our interior renovations is tendered nationally. The other thing we found as an internal opportunity are spaces that were vacant for years that we can now get revenue from. Most of our buildings were built with an awful lot of parking. We have 3 levels of underground garage under many of our buildings. People today don't have 2 cars anymore. We have empty levels of parking. We're renting them to car dealers. We're renting them for storage space. Again, tremendous revenue generators that never even existed on our income statement. So those are, I guess, our opportunities, certainly the external growth and the internal of just maximizing the return from the existing portfolio.
Great. Jack?
Over 35 years ago, when I started in the real estate investment business, I heard about a legendary real estate investor in Texas who was considered the greatest investor of his era. And he was fond of saying that in every 10-year period, there are 3 years to buy, 3 years to sell, and 4 years to hold and do nothing. And whenever he emerged in the market to buy, everybody got excited because he knew it was time. At a macro level, applying that matrix, we may be in the early stages of a 3-year selling window, as we were in 2004 to 2007. I know we'll be speaking later about the potential risks created by high interest rates, the 1,000-pound gorilla in the room, so I'll only touch on it now. Interest rates can't fall much from where they are, and they have been generating most of the real estate appreciation in commercial real estate for the last 10 years. That makes this a very wonderful time to be a seller on a selective basis. I and my partner, Don Paliff, who founded Terra Park, are committed and unemotional sellers. We believe selling is the most difficult component of the investment process. When do you get out? When do you crystallize value? We're proud of selling Terra Park assets before foreseeable falls in value, just as much as or more than making prudent acquisitions before value appreciation. We sold a bunch of our assets before 2008 in anticipation of that crash. We're getting ready to sell more assets now. We're positioning properties for sale. We believe that real estate markets are cyclical, which is obvious, and volatile, and market timing can dramatically improve investment performance. When we put on our buying hat, our view is to proceed with caution. Fortunately, while macro observations are relevant and interesting, real estate is fundamentally a micro business. It's about the property, the sector, the city. Currently, the 2 hottest real estate concepts that we're aware of are the apartment market, where the combination of cheap equity debt and real rental growth is creating a powerful marriage of financial engineering and fundamentals. A lot of money is being made in that sector and will continue to be made for a while. The second concept that is getting a lot of traction now is the wholesale packaging of foreclosed homes in the United States. Early entrants to this sector seem to be doing relatively well. But there is a word of caution. Both markets will get overpriced very quickly. The reality of the modern investment world is with opportunity funds, collateralized securities, proliferation of publicly traded REITs, there are huge supplies of capital that can appear almost instantaneously to take advantage of opportunities. For example, in the US market, last year, 35,000 apartment units were built, roughly speaking. This year, there are about 70,000 under construction. Next year, they expect 150 to 200,000. So you see a very fast geometric progression as soon as an opportunity is realized. In the housing play, Blackstone, KKR, and Colony Capital are leading what is a $10 billion industry that didn't exist 12 months ago, and they're bidding on foreclosed homes. With all that capital running into those markets, the risk reward gets less attractive very quickly. TerraPark is still buying, but the process is grueling, and attractive risk reward investments are a rarity. Fortunately, our target properties and our target cities are under the radar and have not experienced much inflation due to interest rates, and each property has a unique story. For example, our latest acquisition this year was in Cleveland, a very depressed city, but the property we acquired was generating a healthy cash flow from parking, was surrounded by Cleveland State University, which is expanding, and it's an excellent housing site. So once again, real estate is ultimately a micro story, but you have to be observant of macro trends.
That's great. Maybe if I could just go across and ask the question, we have an audience here whose principal focus is as high net worth investors looking at the asset class. Is this a place for the high net worth investor, or is it really a better place for institutional money? I'm going to go Matt.
Sure. I mean, I think it's absolutely a place for the high net worth investor. I mean, one of the things about infrastructure in particular is that returns on this specific asset class tend to be not closely correlated to those on either fixed publicly traded fixed income securities or public equity securities, and so there's a real logic in making an allocation to infrastructure as an asset class, as many pension plans have done, and by so doing, increasing the average return on your portfolio while actually reducing, not increasing risk. And and it's that basic logic that's prompted all of the major large pension plans in the country to make allocations to infrastructure, and now there's a number of small and medium-sized pension plans that are following suit. I think the challenge for high net worth investors has historically been that it's that this has been the realm of big institutions, that it's tough to find vehicles that enable high net worth investors to get exposure to the asset class at investment levels that that make sense and that make it accessible to them. And that's, I mean, one of the things we've attempted to do at Connor Clark and Lund is create investment vehicles that have minimum investment sizes that make them accessible to the average high net worth investor. So, I think on my part, I think the answer is a resounding yes to the question. Should individual investors be getting exposure to this asset class?
Tom?
Yeah, I mean, high net worth investors are the owners and buyers of most of the apartments in Canada. Today, less than 10% of the apartments in Canada are in institutional hands. Our main competitors are high net worth individuals, syndicates, people that have been in this business for a long time. We're trying to convince them that they should be buying cap rate units, not apartments, but they're not really agreeing with us on that, although we think cap rate's a pretty good investment. So that's always been the market. There's always opportunities. Apartments are a very easy entry business. Anybody can go out and start to buy a duplex, buy a fourplex, run it yourself. It's the simplest way to get into real estate, and frankly, that's how all the great empires have been built. So apartments certainly suit that. They're extremely stable. I said earlier we operate at 98% plus occupancy, so there's a lot less risk than with commercial and some of the other types of investment properties. In terms of institutions, it's interesting. When we went public, the institutions shunned us. They didn't want anything to do with residential real estate. It was really a sort of a small owner-operators, high net worth individual type of business. Today they've embraced it. All the major Canadian pension funds are in the business. They're building large portfolios. There's a lot of asset managers representing smaller pension funds, and again, they're prime competitors to us. So I would say today it's both groups, high net worth individuals certainly, but institutions have embraced apartment investment.
Jack?
Yeah, early in our history, we did have pension fund and insurance company investing in our business, and learned over time that it really was a misfit. We're not a play for institutions because of size, the type of properties, the location, the mechanics, but it's a very comfortable fit, I believe, for high net worth investors for a number of reasons. One is the simplicity of it, the transparency. There's no financial complexity, although I'm sure the audience is very sophisticated. We run a business that has no debt. It generates cash flow. It's a simple, rather modest, patient business that is very preoccupied with capital preservation and modest returns on a risk-adjusted basis. So I think it's a good fit for all those reasons.
And let's go to the interest rate question, because you began to introduce it, Jack, and I think it's probably one of the asset classes which are driven a great deal by interest rates and its success over the last number of years. But what about the next 10 years?
Well, I'm not going to speculate where interest rates are going to be, but I think it's pretty safe to say that they're going to go up because they can't go down much more. So sooner or later, it'd be hard to know what the trigger event will be or the series of events, and it's hard to know whether it's a year from now or 3 or 5 years from now. But the only thing that is crystal clear is how dramatic the impact will be when interest rate goes up on the valuation of commercial real estate, because it has been such a major driving force in its appreciation. And for us, it is a preoccupying issue. When we look at a target acquisition, we ask ourselves many different questions, but one of the questions is a stress test. If interest rates go up 200 or 300 basis points, what will happen to the value of the asset that I'm buying?
Tom?
Yeah, I think it's a serious question. Certainly when I'm asked the question, what keeps me up at night, my answer is the risk of interest rate volatility. I think when we look back in the history of real estate investment, where people have gotten into trouble has been through interest rates, not bad real estate, and I think there's a real lesson there. Because of that, what we've done at CapREIT is we're taking advantage of these low rates. I said earlier, we're getting 10-year money at 2.8%. We're getting as much of that as we can. We'd go out 20 years if we can find it, but nobody wants to give us 20-year money. We can find lots of 10-year money. We're today pulling mortgages forward from 2013, paying a break fee, and fixing it at 2.8% for 10 years. And pretty soon we're going to be pulling our 2014 maturities forward, paying a break fee, and refinancing at 2.8% for 10 years. So we don't want any interest rate risk. Like Jack, I'm very concerned the impact it could have on our valuation, certainly in our cash flow, and we'll do whatever we can to fix long-term rates and take all the interest rate risk off of our balance sheet.
Yeah, just a couple of thoughts. On the infrastructure side, we, in almost all cases, finance our assets with debt that, with maturities that match the lives of the underlying contracts. So, as an example, we have an investment in a run-of-river hydro asset in BC, and the asset has a 40-year offtake agreement with BC Hydro, and we financed that asset with 38 or 39-year debt, fixed-rate debt. And we've done the same in almost all aspects of our portfolio. And I mean, one of the comforting things is that, at least for now, there's all kinds of appetite out there among institutions, life cos, and pension plans for long duration debt financing. In fact, many of you may have seen there was a recent Enbridge financing financed with 100-year life debt. There's been a number of infrastructure financings with 60-year life debt, and so there is long duration debt out there, fixed rate debt that that we can use to match the lives of the underlying contracts and assets. The other thing I'd say is that along the infrastructure spectrum, there are assets with what I'd call positive leverage to inflation. There are assets that are essentially neutral with respect to inflation, and then there are assets that are under leveraged to inflation. In other words, as rates rise, the returns on the underlying assets actually decrease. And so one of the things we're attempting to do as best we can is target assets that are over leveraged to an increase in interest rates. And an example of an asset like that is the same hydro asset that I referenced. It has a 40-year offtake agreement with BC Hydro, and the offtake agreement basically commits BC Hydro to purchase all of the power that the facility produces for 40 years at a fixed price that increases each year with 50% of the increase in CPI. Now, the cost structure of this particular asset is such that it represents about 20% of revenue, and so if there's an uptick in inflation, the top line on this particular investment should increase at a rate that's higher than that which the cost structure increases. And so with an increase in interest rates, we should benefit from higher returns on this investment, not lower returns or returns that are preserved. And so to the extent that we can find those kinds of investments, they're pretty attractive to us in light of the interest rate dynamics of the market right now.
Jack,
Yeah, I just wanted to emphasize that in owning a commercial piece of real estate, building or whatever, it's not just the cost of debt issue. Interest rates dramatically impact the value of your equity. So locking down long-term inexpensive debt is a very important thing to do. But you also have to have an awareness that the value of the equity moves dramatically as cap rates change and the acceptable dividend yield changes in a raising interest environment. So there are multiple layers of consequences when interest rates move.
I have some more questions, but why don't I turn to the audience? Are there questions that people... Yeah.
What would you consider to be a good price to pay per unit for multi-res in the USA?
Be a little more specific.
I can't.
Are you talking about for investment purposes?
Yes, of course. Yes.
Okay. My view is you're always better off overpaying for good real estate than buying bad real estate. So I think what you're going to look at is cap rate. I would look for a prime location, a Class A location, and I think today in good places, good markets, I think you can probably find a 5% cap rate, a 5% yield before debt, which would be a very acceptable yield today, and I think would have some growth to it. And the question is, do you buy it with debt or with no debt?
I have one more question, if I may.
I might add one more thing. Tom knows the apartment market backwards, but we deal exclusively in the United States, and rents vary from $1 to $3 a foot depending which city, so the prices are all over the place. There could be a 300% swing depending where it's located.
Thank you. For an investor in the U.S., what would you consider an amount to put in that would make it worthwhile to deal with the IRS nightmare?
I may comment because we have high net worth investors who are grumbling a lot about filing, and we operate not just the United States, but in 8 or 10 different states. And so it's not just IRS, there's also state filings and various other things. If I had to pick a number, I'd probably say it's maybe $500,000. And it also depends if you have infrastructure. You know, if you're doing other things in the United States, it's not that big an issue. If it's a standalone investment, there's money and there's aggravation. And you've got to deal with different jurisdictions, and each of them are as frustrating as dealing with Revenue Canada.
Question in the back? Yeah.
I wonder if Tom can comment on Jack's comment regarding interest rate risk, not from the point of view of input costs, but from the point of view of equity valuation.
Yeah, I mean, he's absolutely right. It's going to have an impact. I mean, our share price moves a little bit like a bond, but I think because apartments are stable, because there's less volatility, and again, we've got a 15-year history in a moving interest rate market. It's primarily moved down, but you can see the trends. It does have an effect, but remember, the other side of that is also the growth. And in our company in particular, I talked earlier about our growth opportunities internally. We're driving a lot of growth. Last year, for example, we grew our bottom line by 7 or 8%. That's fairly dramatic in apartments. That's in a climate where our top line grows by about 2%. Our normal margin is 56 or 57%, so it's all expense management. So there's no one moving target. Yes, interest rates are going to move around, rents are going to move, expenses are going to move, and you've got to look at the whole package over a reasonable period of time, and that smooths it out. But there's no question interest rates do directly affect the value of the equity.
Yep.
Perhaps, Jack, you can clarify. It was mentioned that now is a stable time for apartments, and before you mentioned it might be a period to start to sell, as you said, at your cycle. I'm a little confused. Which do you think?
Well, I mean, I made the distinction between macro observations and micro observations. And I think that the apartment market, and speaking about the U.S. market, which I understand a little more than I do the Canadian market, is actually going through a thriving period of growth right now. So even though many of the sectors are barely growing in fundamentals, rents aren't going up typically in office and retail and industrial in most markets in any meaningful way. Rents in U.S. apartments have been going up something like 7 or 8% in the last 12 months and are projected to continue going up. So in a economy where the GNP is growing at 2%, 7% growth is dramatic. So there is an isolated pocket, and I'm not sure the growth is as strong in Canada, but you also have bars to entry in Canada, so you have more security and higher occupancy rates. So there are benefits in both sides. But there is this issue about equity risk. At some point when interest rates go up, it's going to affect the value of equity in all these projects. So, you know, it's like the stock market. There are buying opportunities in a down market. You just have to be careful.
It's interesting. Jack's comments kind of made me think we're generally a buy and hold strategy, but very quietly we sell, like this year we've sold over 1,000 units. 2 years ago we sold over 2,000 units. So we're traders as well, and a lot of that has to do with future opportunity. We think of ourselves as hands-on operators, and that's why, you know, we talk about many moving parts on our income statement. Once we've maxed out the value of a building and we can't raise the rent any higher, and we can't trim the expenses anymore, that's kind of building we sell, and we recycle that capital into a building where we can add more value and drive more to the bottom line to offset perhaps the effect of interest rates or any one particular effect. So again, if there's enough moving parts and you're an active operator, you can, in a stable apartment business, you can grow your bottom line.
I thought one of the favorite topics in Toronto is to talk about the condo market. So maybe an observation on the condo market in particular here. Are you worried?
Is that a question to me?
Well, everybody will have an opinion. You're all real estate experts. Why don't we start with you?
Okay. I wouldn't use worried. I'd say we watch it very carefully. I mean, it's interesting. 2 weeks ago, I took my executives and we actually did a condo tour of Toronto just to look at what we may compete with in the future. We watch it very closely, and it starts with our marketing department. We're not 98.4 occupied by accident. We're 98.4 occupied because we're at the right rent and we market very, very aggressively. When we have a building, we look at who we compete with, we look at which buildings we compete with, and we do a value approach. So we understand, is their swimming pool bigger? Is their lobby nicer? Do their suites have better bathrooms? We measure all of that to make sure that we're the right value in the market. We're doing that now with the condominium market, and the reality is we're full with waiting lists in all of our central urban buildings because rental apartments are great value. So the example I always use, a one-bedroom condo downtown near the Sky Dome is going to be about 600 square feet. It's going to be owned by an investor that wants to get about $1,600 a month rent. That building's going to have a beautiful gym. It's going to probably have a concierge. The unit's going to have a new kitchen and a new bathroom. And today he's getting $1,600 a month. Our equivalent we own buildings up and down the subway line, Yonge and Eglinton, Yonge and Davisville, Bloor and Church. And our buildings were built in the 60s, and our one-bedroom units are bigger. They're 750 square feet. We don't have a fancy gym, but we have put gyms in most of our buildings. But our rent is $1,100 to $1,200 a month, and we're full with a waiting list in all of those buildings. So it's a very different value proposition. As more condos get delivered, will the competition get greater? Yes. And what we're doing as a company on our central buildings is we're now doing condo quality interior renovations. We're putting in condo quality gyms in our buildings. Where appropriate, we're putting in concierges. And what we're finding is a lot of tenants are choosing professional landlords. They're not having great experiences with independent landlords, with small landlords. And I think that works very much in favor of large corporate responsible landlords. So that's where we are today. Could that change in the future? Absolutely. Is it something we watch closely? Yes, we do.
Jack, you have a point of view?
Well, just as a student of real estate cycles, we're always worried about markets that are extremely hot. And from the second and third-hand information we get about the Toronto market, it appears a higher and higher percentage of buyers are offshore investors, in some cases residents, but in many cases investors. And our concern would be, in addition to the normal supply-demand issues, is offshore investors are not sticky money. They're not users. They'll keep their money here as long as they think that Canadian currency, Canadian politics, the Canadian economy is more attractive than their home country. So that is always a cause for concern. I'd be very concerned as a new investor in the market.
Matt, do you want to take a swing at it, or a bit more questions?
Yeah, might as well go on to the next question.
Okay. Questions in the, any further questions here that people have? Well, let me just go on, pick one for Matt. We have a situation where the federal and provincial governments are under very tight deficit situation, and they are increasingly looking for opportunities to partner with the private sector. Do you see that continuing? And you talked earlier about the pension funds being a much lower cost of capital a group, and looking for inflation hedged assets to match their liabilities. I mean, is a small player going to be able to compete and play in the bigger and bigger projects that are out there, and because the governments are looking for big stuff and less littler stuff?
Yeah, a couple questions there. The first is the implications of deteriorating government fiscal positions. I think there's a couple of factors at play here. One is that over the last 3 decades, really, governments at all levels, municipal, provincial or state and federal, have pretty dramatically underinvested in basic infrastructure. There's all kinds of studies out there that cite figures on the size of what people describe as the infrastructure gap or the infrastructure deficit in Canada. Estimates range from 100 to a couple of $100 billion of underinvestment over that period of time in infrastructure. In the U.S., the estimates are in the trillions of dollars. But I think what's clear is that there's a massive amount of basic infrastructure investment that needs to occur over the next 2 or 3 decades to make up for that period of underinvestment. At the same time, Richard, as you mentioned, you've got governments increasingly dealing with strained balance sheets, and so how do you reconcile those two things? One at least partial solution to the problem is to have governments increasingly look to the private sector to fund a portion of the infrastructure gap, and that's started to occur, but I expect it will accelerate here over the next 10 years. And when we talk about infrastructure investment, just getting to the second question around whether there's a role for small to mid-sized investors. We're not just talking about massive infrastructure projects, although there's no shortage of those that need to be funded. There's also a myriad of infrastructure assets or projects in the kind of south of $1 billion range that are going to need to be funded going forward. And when you sort of work backwards from the total capital cost of those projects at, let's say, take the midpoint between 0 and $1 billion, of $500 million, 90% of that will be funded with debt and the balance equity, so $50 million of equity. Well, $50 million of equity is far below the minimum investment thresholds of the largest Canadian pension plans. I mean, CPP, which would be at the top of that list, won't even look at an infrastructure investment unless it can deploy at least $500 million of equity, okay? And, teachers and OMERS and some of the other big pension plans would be, largely in the same category. I mean, their minimums might be a little bit lower, but certainly north of $100 million. And so there's a whole universe of investments, domestic infrastructure investments that will need to be funded by the private sector that fall below the massive pension plan minimums. And that's our focus. We characterize it as the middle market infrastructure segment. The other, just back on the topic of stretched government balance sheets, the other thing that we expect to see over the next 5 or 10 years is not just new investment in greenfield projects, but the sale by governments of existing infrastructure-like assets in order to raise funds to pay off debt. And a recent example of that kind of phenomenon was the sale over the summer of Enwave, which was in part owned by the City of Toronto. It's a district heating and cooling asset that's Toronto-based. And the City of Toronto basically made a decision that, for both balance sheet and valuation reasons, that it was an appropriate time to be selling that asset. And I think, their decision was largely borne out by the result of the transaction. I think there were something like 20 or 25 bidders evaluating and bidding on that asset, and they ultimately sold it to a large infrastructure fund. And I think we're going to see more and more of that kind of activity from governments over the next 5 or 10 years.
Any more questions from the? Yeah, Ian.
Could each of the panelists tell us over the next 5 to 7 years what the expected rate of return net to investors should be in their space?
Who wants to start?
Yeah. I mean, I'm happy to start. Our long-term target on infrastructure investments, given our focus, which tends to be mostly at the construction stage of those investments, is 8 to 11% net of all fees and expenses, and we think that that kind of return range is achievable even in the context of the current market where long-term sovereign yields are in the 2 to 3% range, and we expect it will continue to be achievable going forward.
Tom?
Okay, CapREIT's total return last year was 36%. It was unbelievable. It was the highest of any other Canadian REIT, and I can tell you right now that won't continue every year. I would say looking forward into the next couple of years, anywhere from 9 to 12% is achievable, and we're comfortable we can do that.
Jack?
Yeah, our target over that time period would probably be in the 11 to 15% range. But I guess there are two things to say. One is those of you who know our business know that if we can't get those kind of returns, we're not buying. So if we have to be inactive for a period of time, we'll do that. And the second thing is that it's very important to talk about risk-adjusted returns. Not just absolute returns, but what returns are on a risk-adjusted basis. And our returns are typically lower than many other funds and operations, but we're getting returns without debt. We've taken out a number of moving parts. So risk-adjusted is always an important issue.
The one question I wanted to ask is, you think about the asset classes which each of you are in. So far today, we've had a number of different asset classes talked about. Real estate is one where taxes, from an investor perspective, can have an impact because long-term holding over long periods of time is a big tax deferral. How do you think about taxes from an investor perspective as you think about the asset class?
At least on the infrastructure side, because we're an investor in construction stage projects, we benefit both from tax write-offs associated with the capital cost of the project, and because these are financed with some reasonable level of leverage, we benefit from the deductibility of interest. And in addition to those things, at least in respect of investments in power generation projects, in particular renewable generation projects, where there are, CERC and other tax attributes that are available to flow out to investors, at least in certain circumstances. The after-tax returns on many of these construction stage infrastructure investments are actually not all that much lower than the pre-tax returns. I mean, typically the tax friction is in the range of 50 beeps to 100 beeps on the kinds of investments we look at. And as a principal investor in many of these investments, and as a taxable principal investor, we're highly, highly focused on, on after-tax returns.
John?
Yeah, very important question for us. Virtually all of our investors are taxable, and we manage our business to minimize tax. We maintain a tax shield in the area of we've never been less than 80%, and we have many years where we're above 90%. It's primarily capital cost allowance. We're able to work within the law. For example, if we buy a building on December 31st, we get our short year for 1 day, and the next year we get full CCA, so you'll always see us closing deals in December. We spend a lot of money on capital. We get some good depreciation rates on capital. And again, our distribution is highly tax sheltered, and I can virtually assure you it'll always stay above 80%, and we like it above 90%.
Okay.
Unfortunately, I don't think we've done one clever thing in the tax domain in 23 years. We don't have buildings, we don't have CCA. You pay tax on what you get, and we're dealing with multiple jurisdictions. So there really is, unless you create a very intricate tax structure in your own entity, there's nothing compelling from a tax perspective in Terra Park.
Thanks. Okay, one last, are there any other final questions before we wrap up? Okay. We managed to get everybody to survive after lunch, so thanks each of you for joining us today. It's a very interesting look at the number of different asset classes and your perspective on them. I know was valuable to me, and I suspect a number of others as you think about your investing strategy for the future. So much appreciated on behalf of Mount Sinai and Prime Quadrant for coming today, and we wish you continued success in your investing careers. Thank you.